continuing in our discussion of Chapter 3, we left off talking about property taxes. So another source of revenue is interest and penalties on delinquent taxes. So when our taxes aren't paid by the due date, the government can put interest on any delinquent taxes and make you pay back the past taxes that are due plus interest. Sometimes there's also a penalty charge in addition to any interest charges. Okay, special assessments. So like I talked about, special assessments are kind of property taxes. They're levied against property owners, generally an extra percentage put on your property taxes for a special building, library funding, new high school, or that kind of thing. When we do special assessments, so if a government is going to put a special assessment on, this has to be approved by the citizenship with a vote. So you'll see there will either be a special vote or as part of the general election. So on the Tuesday after the first Monday in November, we have our general elections to elect people. So it could be a city election, and one of the things that would be on that ballot is, do you approve a 1% tax levy to build a new high school or to make improvements to the library or different things like that? And then you can either say yes or no. If it passes, that special tax levy is created, and if it doesn't pass, then that tax levy fails, and they can either try again or find some other way to fund that project. Okay, licenses, permits. Talked about these: building permits, vehicle licenses, animal licenses, business licenses. So for example, when you register a car, you go to the county courthouse and you register to drive that car within the state. You pay a vehicle license. That license, the amount of that license depends on the value of your car and the weight of your car. The reason that weight is a calculation in a vehicle license is because heavier vehicles cause more damage to highways. So they're trying to recoup some of that money for highway repairs. Intergovernmental revenue. So these are transfers of cash or assets. So it can just be cash, property, supplies, etc., from one area of the government to another. Grants also can be different transactions. They can be government mandated or voluntary. So like if you apply for a grant to the state, and a city would receive a grant from the state or the federal government for a special purpose thing that they wouldn't have to pay back. Okay. Charges for services, we've also talked about these for various different things. So, if you needed police for an event, for like traffic management or things like that. If the street, sidewalk, and curb repairs. So even though sidewalk is on your personal home property, that area of your yard is actually owned by the city government, and it's called an easement, where the property owner and the city government kind of share ownership. This allows for city utilities and stuff to be installed in that area. So the city can come in and repair your sidewalk and then charge you for it, for example. Okay, and then miscellaneous revenues. So private contributions. Somebody decides, I just want to give money to the city of Waverly or the city of Cedar Rapids or the city of Des Moines or anything like that, right? either for a special purpose, or maybe I decided not to gift it to anyone in my family. Okay. Public enterprise contributions, interest, accept interest on taxes, rents and royalties. So if we rent out public buildings, for example, and then escheats, which we were talked about extremely briefly in the textbook, but that is where the government can appropriate property. Okay, so that's revision of property to the state, where like a person dies and they don't have any family and they didn't have a will stating what to do with their property, all of their property reverts back to the state, and then the state determines what to do with that property. Similarly, if somebody dies without a will, their property still reverts to the state, but if they have living family, that family then has to fight the state to get it back. So this is a reason why it's very important to write a will. Okay, and then really anything that ends up in that other category that either increases or decreases fund balances. It doesn't meet the definition of revenues that we've gone over, or the expenditures. This includes interfund transfers and bond revenues and or debt service. So that's what we call when we have bonds in government, that we have a debt service that requires paying for that bond. Debt restructuring would be like if we asked for an extension on the bond, if we lowered interest on the bond, different things like that. And then asset sales are also other financing sources or uses if we would have gain or a loss on sale. Okay. Then we're going to record our budget. So that's actually going to be one of the first things we do in our examples, is record our budget. So as part of our budget, we are going to record our estimated revenues. So what are all of the ways we think the government is going to get money in? Then we're going to record appropriations. So remember how appropriations are those expenditures that we're going to make to different programs. Okay, then our encumbrances. So what the difference between an appropriation and an encumbrance is an appropriation is as part of our budget process, we said the police department's going to get $1 million. That's an appropriation. An encumbrance is when the police station then orders something to use the money that the government sent to them. So an encumbrance is, so say we would order, as a business, we would order supplies, and we would get those supplies and we would record that we have supplies on hand, and then we have an accounts payable that we're going to pay that supplier, or we bought the supplies with cash. In a government, what happens is when you generate the order for supplies, you have created an encumbrance. So you have promised government funds to purchase supplies. Then later, when the supplies arrive, you reverse that encumbrance and then record the expense, or expenditure as it's called. So that double modified accrued accounting is one of the unique things where it's really like you're doing every transaction twice, because you're recording the encumbrances before the expense happens, and then reversing the encumbrances and recording the expenses. Okay. Then we have the other estimated other financing sources and uses, which we have talked about. Okay. Each revenue account has a comparable estimated revenue account. So this allows us to compare of the actual revenues received to the estimated revenues that we said we were going to receive. For example, we might say we're going to get this much in property taxes because this is the value of property and within our state, and this is how much we charge per, or within our city, and then this is how much we charge per property for tax. However, property taxes are paid twice a year. So even if you say you're going to get that revenue, it might be 6 months before you start receiving some of it. And then a portion of your taxpayers might decide not to pay that year. And then you have delinquent taxes. So that's what that revenue is. So you have your estimated revenue as part of your budgetary accounts, and then the actual received, so you can do comparisons. Encumbrances and expenditures. I talked a little bit about this. So each purchase order and contract we look at, then we'll go back to that police example. So we appropriated $1 million to the police department. Okay. Then the chief of police decides to buy a new copier, and he submits a purchase order to the government purchasing department saying that he wants to buy a new copier. It's going to cost $3,000. So the very first thing the purchasing department is going to do is say, look at, do they have sufficient appropriation involved? Then they're going to record that $3,000 is encumbered, because they just submitted a purchase order, which means now it's not available to anyone anymore. Okay. When the good or services then is actually received and we've made the payment, then we're gonna record the fact that we have completed an expenditure. And of course, we're going to practice this in our examples. Okay. So we have appropriation, then encumbrance, then the expenditure, then the disbursement. Okay, so first we appropriate certain funds through the budgetary process, then we encumber funds by making a purchase order, and then we actually receive the item, which creates an expenditure, then we actually pay for the item, disbursement. Okay, so some extra steps for government accounting versus business accounting. During the fiscal year, we can revise the budget and legally amend the budget. In fact, we might be forced to, because city and states are not allowed to hold deficits. So during the year, as we compare our actual to our budgeted amounts, we are going to have to make amendments if we suddenly realize that our revenues aren't going to be realized, or if there are other kinds of changes and we're going to have more expenses than revenues. Then we are legally required to make amendments to the budget to make sure that we do not spend more than we are bringing in. The federal government can operate at a deficit, but state and county and city governments cannot legally operate on a deficit. Okay. Of course, at the end of the reporting period, we conclude closing entries and then create financial statements. This is very similar to a business where we have accounts that get closed at the end of each accounting period and then get reopened at the beginning of the new reporting period. We're not going to look at closing entries for several more chapters. We're going to, so chapter 3, we're really just recording the budget, looking at recording the budget, and then looking at a couple of the different statements. Then throughout the next couple of chapters, we'll be looking specifically at different transactions that happen within accounting periods and how those transactions are repeated. And then we'll look at closing entries, financial reporting, and financial statement analysis. Then we move on to the nonprofit chapters. So that's the end of the chapter 3 lecture.